Imagine spending your entire life working, saving, and believing you're building wealth, only to find out decades later that the system you trusted was quietly taking more from you than the market ever did. The real threat to your future isn't a crash, a recession, or bad luck. It's the slow, invisible drain of fees, hype, and conflicts of interest disguised as professional management. While you were told your money was being invested for you, it was actually being harvested from you. And that's the quiet truth the mutual fund industry never wants you to realize, because the moment you do, the game changes forever. The truth every investor needs to face is this: the market gives, but costs take away. The miracle of compounding works both ways. Just as your investment return compounds for you, your costs compound against you. And those costs, fees, turnover, taxes, hidden charges are not minor. They are the silent killer of wealth. Most people think that the market determines their destiny, but more often it's the costs they willingly sign up for that quietly erode their future. Think about it. The average investor might expect the market to return, say, 8%. But when you pay a management fee of 1%, add another 0.5% in trading costs, and lose another 0.5% through tax inefficiency or fund overhead, you're suddenly giving away a quarter of your return every single year. Over decades, that small-looking percentage compounds into a staggering loss. You could easily end up giving away half of your potential wealth, not because the market failed, but because you didn't notice the small leak in your boat. Costs are relentless. They don't care whether the fund performs well or poorly. They get paid either way. They are deducted before you see your return, before your savings even have a chance to grow. And that's the flaw most people overlook. We live in a world where the financial industry has mastered the art of collecting tolls on the investor's road to compounding. The marketing slogans sound brilliant: smart management, exclusive strategy, top-tier expertise. But those words mask the reality. You are paying a premium for activity that statistically fails to deliver superior results. The numbers don't lie. Over long stretches, roughly 80% to 90% of actively managed funds underperform the market after fees. And yet the fees continue. The irony is painful. The investor, not the fund company, carries the burden of underperformance. The companies build their profits on the volume of assets they manage, not the value they create for you. Every dollar you pay in expense is a dollar that doesn't compound for your future. Even turnover, the trading of securities within the fund, carries a cost. It's not only the commission or the bid-ask spread, it's also the tax hit and the opportunity loss. Each trade chips away at your compounding base. Every unnecessary transaction is a decision made on your behalf that takes money out of your pocket. The fund may look busy, but that activity rarely translates into better results. The truth is that the most productive strategy for most investors is often the simplest: buy, hold, and let the market do its work. If you want to know who benefits most from high-cost investing, just follow the money. The managers, brokers, and intermediaries thrive on your participation. Their revenue is your expense. It's an industry designed to look like a partnership, but in many ways it's a business extracting rent from your capital. That's why the key to successful investing isn't chasing performance, it's minimizing cost. Every basis point saved is a guaranteed increase in your return. You cannot control markets, but you can control expenses. And the investor who learns that lesson early will outperform most others over a lifetime, simply by refusing to let costs eat what the market freely offers. When people first start investing, they believe success lies in finding the right manager, the one with the magic touch, the brilliant insight, the unique formula to beat the market. The advertisements reinforce that illusion. Every year we see glossy brochures and confident fund managers pointing proudly to their latest streak of outperformance. But dig a little deeper, and the story changes fast. The truth is that the odds are overwhelmingly against sustained success in active management. Very few funds beat their benchmark in the long run, and among those few, even fewer hold on to that lead for more than a few short years. This isn't a matter of opinion, it's arithmetic. The stock market is a zero-sum game before costs and a negative-sum game after costs. For every manager who wins, another must lose. The market's total return is the average of all participants' results. So when you layer in expenses, management fees, trading costs, taxes, the average investor must, by definition, underperform the market itself. It's a simple logic. You cannot have everyone outperform an index that represents everyone's collective performance. Once you account for fees, the picture becomes even clearer. Outperformance isn't just rare, it's nearly impossible to sustain. Look back over the decades and you'll find that most funds that outperform for a short period are often the result of chance, not skill. Markets move in cycles, and a certain style, value, growth, momentum might dominate for a while. Funds riding that trend look brilliant and investors rush in, chasing the past. But cycles turn, leadership changes, and the same star funds suddenly fall back to mediocrity. It happens again and again. Yesterday's hero fund becomes tomorrow's disappointment. The illusion of skill is powerful. Investors want to believe that someone can consistently find the next winner, time the market perfectly, and sidestep declines, but time after time, data shows the opposite. Study after study has revealed that persistence in performance is extraordinarily rare. Out of thousands of funds, only a handful manage to beat their benchmarks over a decade, and even then it's often by razor-thin margins that vanish once adjusted for risk or cost. You might as well flip a coin and pick a fund at random. The odds wouldn't be much worse. And yet, investors keep paying for this illusion. They pay high fees to chase the mirage of consistent outperformance. They move money from one top performer to another, always a few years too late. The pattern is as old as the industry itself. Investors buy after good performance and sell after poor performance, doing exactly the opposite of what they should. The fund companies know this, and their marketing departments thrive on it. The real tragedy is that most investors don't need to play this rigged game at all. They could simply own the entire market through a low-cost, diversified fund and capture almost all of what the market delivers. No searching, no guessing, no chasing, just owning. But human nature makes simplicity hard. We crave excitement and the promise of beating others. Yet, in the race for returns, humility often wins. The market rewards patience, discipline, and low cost, not brilliance. The odds are stacked, yes, but not against you if you choose the quiet, sensible path. Because the surest way to win in investing is to stop trying to outsmart the very market that already reflects everyone's best guesses. One of the least discussed truths in investing is that the structure of an organization often determines whose interests it truly serves. Many mutual fund companies are not owned by the investors whose money they manage. They are owned by external corporations, insurance firms, or financial conglomerates. And in that structure lies a quiet but powerful conflict of interest when a firm's ultimate duty is to its external shareholders, not the fund investors. You can be sure that maximizing profits takes precedence over maximizing investor returns. This simple structural flaw shapes everything that follows. Think of it this way. A mutual fund should be a trust, a vehicle that exists to serve its investors, not to exploit them. But when the management company itself is owned by another corporation, the incentives change. Suddenly, growth in assets becomes more important than growth in investor wealth. Marketing becomes as essential as management. The business begins to focus not on how to deliver better results for shareholders, but on how to attract more assets under management, because that's where the revenue lies. Every dollar brought in generates more fees, regardless of whether those dollars earn their keep for the people who supplied them. This is where the system turns upside down. Instead of the fund existing for the investor begins to exist for the fund company. The firm's profits rise as assets grow, even if returns lag. The incentive is to sell performance, not deliver it. So managers launch new funds to ride every market trend. Tech funds when technology booms, energy funds when oil spikes, ESG funds when sustainability headlines fill the air. The aim isn't necessarily to help investors, but to capture the next wave of inflows. When the trend fades, the fund quietly disappears, merged into another, and the marketing machine moves on. Meanwhile, the external owners of the management company expect their dividend checks, their quarterly profit growth, their rising share prices to satisfy them, or must earn ever higher fees. Where do those fees come from? From the pockets of the investors themselves. The shareholders of the fund company win, the shareholders of the fund lose. That's the hidden tension at the heart of the system, a misalignment between those who provide the capital and those who control it. True alignment would mean that the fund management company is owned by the funds it serves, that the investors themselves indirectly own the firm. In that case, profits don't flow out to external shareholders. They stay with the investors in the form of lower costs. But when ownership is external, the motive becomes clear: extract value, not share it. It's not that people working in these firms are dishonest or malicious. It's an incentive-shaped behavior. If your compensation, your growth targets, and your shareholder expectations all depend on gathering assets and charging fees, then inevitably the client's best interests will take a back seat. The system rewards scale, not stewardship. And so investors must remain vigilant, always ask, who owns this company? Who are they truly working for? Because if the answer isn't for me, then your returns are quietly paying someone else's bonus. Structure may look professional, the brochures may sound trustworthy, but unless the incentives are aligned, your financial future is merely another line on their income statement. There's a simple truth in investing that too many people overlook. You don't have to beat the market to win. You just have to match it and do so at the lowest possible cost. That's where low-cost, broadly diversified funds come in. They don't promise miracles, they don't chase headlines, and they don't rely on luck. They simply give you what the market gives, minus a very small fee. And that, over time, beats the vast majority of investors who try to do more and end up with less. The logic is disarmingly simple. The stock market as a whole is a collection of all investors' holdings. Before costs, the average investor must earn the market return. After costs, the average investor must, by definition, earn less than the market return. Therefore, the most reliable way to outperform the average investor is not by guessing which stocks will rise or which manager will win. It's by minimizing what you lose to costs. Low-cost index-type funds accomplish exactly that. They capture the total return of the market with almost no friction, allowing compounding to work its magic without interference. Diversification is the second pillar of that approach. It's the recognition that no one, not even the brightest analyst, can consistently predict which individual companies or sectors will thrive next year, next decade, or in the next market cycle. By owning a broad slice of the entire market, you don't have to guess. You automatically own the winners of tomorrow without having to identify them in advance. That's the genius of simplicity. Rather than play the endless game of selection and timing, you let capitalism itself do the heavy lifting. As businesses grow, innovate, and adapt, your portfolio benefits automatically. The beauty of this strategy lies in its humility. It doesn't rely on forecasting. It doesn't depend on market timing or emotional decisions. It acknowledges the limits of human foresight and focuses instead on the few things investors can control: costs, diversification, and time. Those are the real drivers of success. The more you trade, the more you pay. The more you pay, the less you keep. The less you pay and the longer you stay invested, the more certain your outcome becomes. It's almost ironic that what seems so average on the surface, the market return, is in fact extraordinary over time. The long-term record of equities has been generous to patient investors. A low-cost index fund harnesses that generosity without the noise and complexity that plague active management. It transforms investing from a competition into a partnership with the economy itself. As productivity rises, as companies earn profits, as dividends grow, you share in it automatically. Many investors still chase the illusion that someone out there can deliver a shortcut, a higher return without higher risk. But when you strip away the layers of marketing and complexity, the math always leads back to the same conclusion: low cost and broad diversification win. Every time you refuse to pay unnecessary fees, every time you resist the temptation to jump in and out of markets, you tilt the odds in your favor. So the better way isn't glamorous. It won't make you feel clever at cocktail parties. It's patient, disciplined, and quietly powerful. It turns the game of chance into a process of accumulation. And the beauty of it is that it works not because it's new or secret, but because it's built on principles as old as compounding itself. Low cost, broadly diversified investing doesn't just make sense. It makes wealth inevitable for those willing to let time and simplicity do the work. The secret to successful investing is not found in complexity, it's found in simplicity. The world of finance loves to make things sound complicated to convince you that you need experts, formulas, and forecasts to survive. But the truth is far less glamorous and far more powerful. Simplify, hold long term, and ignore the noise. Those three principles will do more for your financial success than any trading strategy ever will, because investing is not about activity, it's about ownership. patience, and discipline. Simplicity means focusing on what actually matters: cost, time, and behavior. You don't need a dozen funds, exotic products, or constant market updates. You need one clear purpose to let your money work for you quietly, efficiently, and with minimal interference. Every extra layer of complexity, every special product usually benefits the seller more than the buyer. The more moving parts in your portfolio, the more likely someone is collecting a fee from your uncertainty. Complexity is profitable for the industry because it creates dependence. Simplicity is powerful for the investor because it creates independence. Holding long-term is the next essential truth. The market will rise and fall, often violently. There will be recessions, bubbles, booms, and busts. But if you stay invested, ignore the daily headlines, and let compounding do its job, you will come out ahead. Every time you react to fear or excitement, you hand over part of your return to someone else. The traders, the brokers, the middlemen who thrive on your movement. Time in the market will always be timing the market, because compounding only works for those who allow it. And perhaps most important of all, ignore the hype. The financial world thrives on excitement. Every few years there's a new revolution in investing, a new sector, a hot theme, a must-own fund. The media amplifies it, fund companies package it, and investors chase it. But hype is the enemy of long-term wealth. It invites emotion into a process that should be governed by reason. When everyone else is chasing the latest trend, your greatest advantage is the courage to stand still. Real investing is boring, but its results are not. Before you invest, ask one simple question: does this fund serve me, or does it serve the business of the fund company? That one question can save you a lifetime of regret. If a fund structure, fee, or strategy benefits the firm more than the investor, you already know the outcome. High costs are a slow, invisible drain. You might not feel them today, but over decades they compound in the wrong direction against you. Even a 1% annual drag might seem harmless, but stretch it across 30 or 40 years, and you've surrendered a third or more of your potential wealth. That's the tragedy of unnecessary cost. It steals quietly, year after year, without headlines or alarms. The difference between an investor who pays attention to cost and one who doesn't can mean the difference between financial freedom and disappointment. Simplicity, patience, and cost awareness don't sound exciting, but they are the foundation of real wealth. Ignore the noise, stay the course, and let your money grow in peace, because the markets will always fluctuate, but principles like these never go out of style. Please ask the right questions. Are you paying someone else more than you would pay yourself for doing less? Are you buying promises instead of reality? Are you letting fees, structure, and behavior erode your outcome? If you are, then we're not talking about a fair investment. We're talking about a disguised cost. Some might call that a scam, not in the sense of fraud necessarily, but in the sense of unfair economics stacked against you. So stand firm, demand transparency, choose simplicity, recognize that you are the long-term owner of your savings, not the fund manager's fast-moving vehicle. Let your money serve you, not someone else. Thank you, and I wish you clarity, low cost, and steady outcomes.